Hey everyone, welcome to my Patterns and Profits podcast. It's Friday, May 17th. It's actually I'm recording this on Wednesday, but this is for Friday, May 17th. There's a reason I'm recording this early. And it has to do with the trade I'm going to take while we're doing the podcast. So, not to induce any trading, that's why I'm doing it. I'm doing it live on the podcast, but by the time you get it, the trade's going to be done. It's a 2-day trade. So I'm using Friday's options on Wednesday. I wonder if you can guess what stock I am trading with 2-day options. Here's a clue. They have the highest volatility of practically any option that I found this week. It is a stock that started its rumbles or its roar the prior weekend, and it's one that mainstream media didn't pick up until Tuesday. And then, of course, it's been all the rage, and I'm fading the rage. So we'll see. I'm gonna go through it and detail it out here for you in a few minutes. But I thought I would, and you guys all know what I'm talking about, don't you? I want to talk about sell in May, stay away. What's going on as we're halfway through the month? Yes, I'm talking about GME. I'm talking about GameStop. And I'm talking about Roaring Kitty. All right. And me trying to fade the memers because it's worked so much for so long. I'm going in and I'm doing a little trade, something that I don't have to worry about, something that is not going to affect my sleep at all. Okay. And I want to tag on trade management to this. So that's what I'm going to do for this podcast here. All right. So let's go ahead and adjust your seat. Maybe take your iPod Pro out of your ear, scratch your ear because it's going to be a good one, and put it back in. I'll wait for you. Oh gosh, we're under a tornado watch right now. I mean, it's the middle of May here, and April showers bring May flowers and bring tornado watches to Central Florida. When's this going to end? Oh, now, nope, that ended. That's great. Now we're under a severe thunderstorm watch for the next 6 hours. Fantastic. All right. So anyway, all right, we're ready to get going. So sell in May or stay in May? What's working? A couple weeks ago, I started talking about sell in May or stay in May. And we wanted to look at, we looked at the long term, what the theory was behind sell in May. And we also talked about what we saw happening in the last couple of hours. Last couple of hours. I'm still on the severe thunderstorm watch. Last couple of years. In fact, the last 10 years to be precise. I'm walking down the hallway right now. It is so stale in my office. I've got to force the air conditioning down a little bit. Get some breeze going on in here. All right, I'm coming back. This is what live podcasting is all about. It allows me to do whatever I want. And so here we go. I'm back. All right. So let me give you some stats. Okay. So the theory is that between May and October, the markets are supposed to be weaker. And between November and April, the markets are supposed to be stronger. And what we found, and this was decades of research, is it was pretty much a coin flip. I think it was 52-48 to the bears. That's pretty much a coin flip in my world. So we took a look at volatility. And this is what was interesting. Volatility was typically higher by the time we got to the end of October versus where we were in May. So that one was a pattern to me. But it wasn't a pattern enough to say sell the market, sell in May and go away. What we determined was that overall, the markets just go up less between May and October than November to April. Okay? So what we determined is that, well, if the markets are going to go up between between November and May, let's just buy more in November. That's a pattern. Okay, but what do we do now? Well, what we do now is we look at not the last 50 years, not the last 100 years, because times have changed. 100 years ago, a lot of people didn't have electricity. 100 years ago, we didn't have computers. The way we were storing data was on a piece of paper. And the way we were looking at stock prices was on a chalkboard. A lot of things have changed since then. So I looked at the last 10 years of data, and I looked at the most popular stocks in the last 10 years. Yes, the tech stocks. Yes, the consumables. Yes, the retail stocks, and a bunch of others in between. And what I found was that the majority of these things went up in the month of May in the last 10 years. In fact, I shared it with everybody. If you don't believe me, go check out the videos that I did over the last couple of weeks. So, where are we now? That's the million-dollar question. Where are we now? So, guys, first 2 weeks of May look like this, okay? We started out the month in the S&P right above 500, all right? Where are we now? All right. You want to know where we are right now? I'll tell you where we are right now. The S&P 500, if we look at the actual S&P 500, it's gone from about 5,000 to about 5,300 in the last 2 weeks. That's a fantastic move in an area where the May was supposed to be a down month. Okay. That's actually about a 530 on SPY, so about 500 to 530. That's 6%. Are you right, Tom? 6% move just in the first 2 weeks of May? Well, that's what it looks like on my screen. If you take 530 and you subtract 500 from it, you get 30 points. 30 points over 500 is 0.06. 6%. In a market that over the last decade returns what, 10, 11% a year? Fantastic. All right, so sell in May or go away or stay in May and make money today. And we really are staying in May and making money today. And a lot of people are trying to figure out why. I'm not a why guy, but why is this working? Aren't people suffering? I mean, I saw an article that came out that said, as of November 2023, now this was 6 months ago, but it's still pretty relevant today. 62% of Americans are living paycheck to paycheck. All right. This is a report that came out by Payments and Lending Club. Now, 45% of those adults, that means almost half. So almost half are making over $100,000 a year. So think about this for a second. 62% of Americans are living paycheck to paycheck, and almost half of those, are making more than 6 figures a year. Now, to be fair, and all of you know this, $100,000, it ain't worth what it used to be, okay? You look at the inflation that's happened in years. I mean, house prices, now I can only comment on what I see and what I know. House prices since probably about 2017, 2018 have doubled in value in the area, in a little pocket of Florida that I'm in. But they've gone up 50% in value when you look at nationwide. And that's even the flyover states. So, you take a look at that data, and $100,000 is not what it used to be. When you look at food, and you look at transportation, and you look at every number of inflation, it's funny when the government comes out with the inflation reports, they call it X food, X energy, X this, X that. They basically take everything out and they say, oh yeah, inflation's only gone up 2%, 3%. Well, that's because you took everything out that allows us to live like humans. So Look at that. $100,000 doesn't buy what it used to. And here's the thing. Most people that I know have not doubled their paycheck in the last 7 years. They haven't got a double. Maybe they got 20% more, but 20% doesn't help when the average thing is double what it was 7 years ago, double what it was since COVID. All right. Now you wonder, why in the world am I talking about this? Because the stock market, okay, the stock market is not relevant of how you and I and the average consumer is feeling right now. Okay. Wall Street, in a lot of cases, is opposite the economy. Now, the economy is doing well, but people are suffering. There's also a report I saw earlier this week that said credit card debt is, what is it, over $1 trillion right now? It's as high as it's ever been. And, I don't see, I almost see the same kind of thing that happened in 2005 is happening again, where credit cards are opening up, they're raising limits for people because people are making more. If people are making more, credit card companies are just taking this arbitrary number and saying, well, yeah, you make 20% more, we'll give you 20% more in a credit limit. What they're not realizing, or what they haven't factored in yet, is that it costs more to live. Cost of living's gone up quite a bit. I think this is going to eventually backfire. Is it going to happen tomorrow? Well, the market doesn't seem to think so. The market's moving ahead. And, I look at this and I think you have to be in the market to tread water with what's going on with inflation, to tread water with what's going on with the cost of goods. And that's why May is a breakout month. May is going to be, we're going to be done in the next 2 weeks. And more than likely, May is going to show some new all-time highs. Some new all-time highs for the Dow, the S&P, the NASDAQ. S&P and NASDAQ for sure. Dow probably. So at the end of May, there's going to be a lot of people scratching their heads saying, what happened with sell in May and go away? Because if you sold in May and you went away, you're coming back more broke on another day. And like Forrest Gump says, that's all I'm going to say about that. All right, let me look at GME. Let me look at GameStop right now. I got to make a trade. So I'm going to make a trade, and what I'm doing is I am buying. I'm going to give you the Reader's Digest version first. Then I'm going to back up and I'm going to talk about this a little bit. And this is where I really want the majority of the rest of my podcast to go. So I am going to buy the May 17th 40 calls, and I'm going to sell the May 17th 35 calls. So I'm doing a call spread. Now I'll get back to what this is in a moment. Before I even get into meme stocks and what the heck has been going on in the last week, let me just say this. Some of you, if you're late, all right, if you're late to the podcast or you didn't listen, like my wife and kids, if you didn't listen, I say something, I talk a lot. That's what I do. And a lot of it goes in one ear and out the other. And if all of a sudden you're waking up and go, wait, hang on a second, Tom. Stop. This isn't going to work. Tom, it's May 17th. You might be getting this after the market's closed. How are you trading May 17th options after the market's closed? I'll say this. I said it before. I'll say it again. I'm doing this podcast a couple of days early. It's because I got someplace to be on May 17th. But I'm doing the podcast a couple of days early. And I'm also telling you about this so that you cannot do it. Because I don't want to induce trading. I don't want to front run you. So I'm using this as an experiment. As an experiment that has worked so many times before. Now, me on a Wednesday is saying, is it going to work by the time you hear about it? I don't know. I honestly don't know. Okay. It might go against me. GameStop is a stock unto its own. And honestly, I was waiting for a down day for this to happen. So if you go back and you look at Wednesday, you're going to see a crush of 30% on the stock. Now, I wish it hadn't crushed that much, but I'm leaning into this 30% drop today, and I'm putting the trade on right now. And so the trade's on, and I am buying the 40 calls for May 17th, and I'm selling the 35 calls for May 17th. This is referred to as a bear call spread. I just got filled on it. I got $1 for the trade. So we'll talk about all the nuances around it in a moment. Okay? So let's talk about meme stocks. So this all started, I'm going to tell you when this really started. This really started Friday when my research team saw a small spike up in GME. Okay? Was looking at GME and saw this little spike up on the stock. And so it was by the close of the day, the afternoon, and we were looking at GameStop, and this was on a Friday. And what happened was GameStop went above $20 a share. Now, it hadn't been above $20 a share in quite some time. It did close down, and it did end the day in the 17s on Friday, but it spiked up enough where all of a sudden it was getting noticed. Now, the weekend went by, and on Sunday, the Roaring Kitty, right? This was the online screen name of a gentleman by the name of Keith Gill. He was one of the leaders of the Reddit Wall Street Bets, right? This is the forum in which he and a bunch of others really inspired, and I also believe induced, mass trading of GameStop. This was back a couple years ago, 2021, 3 years ago. And their whole, now, to his, I'm going to come to his defense for a moment. He did a really good piece on the fact that there was a lot of short sellers in GameStop, a huge amount of short selling. I believe the leverage was well over 100%. So there were folks that were leveraging their short sells because they just thought this stock was going to go to zero. And yet the stores were still open. He couldn't understand it. He wrote up a piece on it, and it went viral. Okay? So there you go. From there, they were then purchasing GameStop and GameStop options, and the out-of-the-money call options, which was leverage on top of leverage, which was what a lot of people were buying. That's what really pushed this past even mainstream media into your local news. When local news started talking about it, that's when it was too much. And what happened? A few people got rich, and a lot of people got poor. And a lot of people, I'm not going to say got poor, it's that they ended up with nothing. And a lot of folks were using their money that they were receiving, that stimulus check they were receiving from the government. Those extra stimulus checks that I think are the cause of the inflation we're in right now. Right? We didn't need all that, but it was promised. And, God forbid, politician, doesn't keep their promise. I mean, they typically don't anyway. This is one promise that President Biden was planning on keeping. Little did he know it was going to backfire miserably as we're sitting into the inflation situation we're in now. All right, I jumped off the track. Back to GameStop. So what has happened since then? Well, GameStop came crashing down, and Keith Gill, all of a sudden in 2021, drops off the radar. Has one post, I'm going away. That wasn't exactly what he said. But then he dropped off the radar for 3 years. He showed up on Sunday and put a little meme, a little wordless meme out on social media. It was on X. It was on social media. It was a picture used by gamers. Now, I don't have a gaming chair. I have one of those. I don't know what this is. I got this at a charity auction. It's a really nice chair. Maybe it is a gamer's chair, but what is it? Hemmecker Schlemmecker? I don't know the name of the company that makes it. Hamel Schlemmel, whatever. They make this chair. It's really nice. It has a lot of different features on it. but it just feels good. And this is what I use as my office chair. So he had a post of, when you lean back in the chair, you're not worried about anything. I'm leaning back in mine right now. I'm looking at the ceiling. I'm relaxing. And then he shows the move where the person comes up in the chair and leans forward to look at the laptop, to look at the monitor, because all of a sudden things are getting serious. That's what the meme was that he posted out. That was his first post, folks, in almost 3 years. This guy disappeared for 3 years. He puts a post out there. That was on Sunday. That pushed GameStop shares up from, I'm going to run it through to you, from $17 to $30. That was a 75% jump. The following day, that was Tuesday the 14th, stock opened at $65. Let me tell you where it was between hours. On the 24-hour market, on the extended trading market, GameStop reached a high of $80 a share. I say that because you want to know the last time it was at $80 a share? I'm going back to look right now, see if I can even find it at $80 a share. I mean, $65 a share was one thing. Okay, here you go. Last time this stock was at $80 a share, you have to go back to June the 1st? Is that right? June the 7th, the week of June 7th of 2021, GameStop spiked at $80 a share. It also spiked above $80 a share back in March of 2021, and its all-time, well, maybe not all-time high, its 2021 high was above $110 a share. It went to above $120 a share on January 25th. There has been only 3 times that I have ever seen GameStop above $80 a share. And it did it earlier this week. You won't see it on the chart because you got to have that extended hours 24-hour market. But I'm telling you, it happened. It happened. And if you look at Wednesday, which is today for me, if I look at Wednesday, then I see, really Tuesday, not Wednesday. Tuesday, it opened at 64.83. That was the high. It closed below 50, and then last night it was back above 57. I don't know where it hit yesterday because I got tired of looking at it, but I thought if this thing does a reverse candle and comes down, then on my podcast, I will take a trade, and a trade I did. So what did I do? I'm going against what has happened once, twice, 3 times a GameStop. Yeah, that's a song back in the 70s, I think. I don't even know how I remember that. I was in grade school then. You look at the last 3 days, definitely shows a reversal of such. Where do I think GameStop's going to end up at? I believe we'll be below 25 by the time the week is ended. It's a pretty tall call, but we'll see what ends up happening. But trying to time these things is the hardest thing for an option trader to do, for a trader in general. If you're short the stock and you can handle the potential squeeze, then time's on your side. But as an option trader, time's not on your side. So how do you put time on your side as an option trader? Well, what I like to do is give up a little bit of reward, take a little more risk, and put on a probability trade. So with the stock trading in the mid 30s, okay, in the mid to low 30s, I'm going to sell those at the money call options, and I'm going to buy out of the money calls, and I'm putting the break even above the current price of the stock. Now, I got to tell you, this stock's moving around at breakneck speed. So one moment I'm going to be out of the money, and one moment I might be in the money. But what I'm looking at is the rest of this week for GME to fizzle. Is there a guarantee it's going to fizzle? No. All right. Am I trading a pattern? Yes. The pattern I'm trading is the super high volatility pattern. Let's talk about patterns for a moment, because I know you're listening to this podcast because you can't see it. So I got to put the pictures in your mind. Picture this. Do you know where the VIX is trading right now? The VIX, the VIX. or let's just say volatility for the S&P 500, around a 12, all right? Around a 12. That just gives us an idea what the percentage movement is that's going to happen with SPY over the next X number of days. Let's call it 20. That it's going to stay in a 12% range. Okay. You ready for the volatility, or let's call it the VIX, if you will, of GameStop? Well, the options that I traded yesterday, because they're moving around like crazy, but yesterday, the out of the money call options that I was looking at were trading at a VIX, or a volatility, of 750. Actually, 754. 754. That meant that the expectations were that GME was going to have some huge volatility over the next few days. I like selling high volatility. I like buying low volatility. It's hard to buy low volatility with the expectation of it moving higher. It's hard to judge that. There are some times in the life cycle of stock where you can find options that typically bottom out or even move higher. But it is easier to spot extremely high volatility that could drop over the next several days to several weeks, right? We saw it happen with GameStop back in 2021, in January, in March, in June, right? January, March, June, those were all 2 to 3 months apart. Now we're getting the start of this. And is GameStop likely to have the same kind of pattern that it did in 2021? Possibly, but I'm going to say probably not. Not probably. And the reason why is because when you look at the data on GameStop, when you look at the data, a couple of things are different between what's going on today and what happened in 2021. In 2021, the retail crowd had a lot more money than they do right now. And it was thanks in part to the Treasury Department. They don't have that money now. Remember what I told you? 62% of Americans are living paycheck to paycheck. And almost half of them are making over $100,000 a year. These people don't have the money to blow on a GameStop trade like they used to. That's the first thing. Number two, options volume was at some astronomical levels going into January, going into March, going into June of 2021. It's not there yet. It might be, but it's not there with the kind of moves we saw happening. And, up and away for GameStop this week became up, and down. Now, I might be wrong. This thing might take a turn and run to 100 or run back to 80 or 100 or maybe even more. If it does that, then I'm going to take a longer term trade, bearish trade. Right now, I'm just putting my toes into the hot water to see if it's going to cool off, because statistically, this should cool off. So that's what I'm doing with GameStop. A couple questions that might pop up. That might pop up in your mind. What is my trade? My trade's a bear call spread trade. So what I did was I basically sold the at-the-money calls, and I bought 5 points higher the out-of-the-money calls. I sold the at-the-money calls to take in all that premium. I bought out-of-the-money calls for protection in case I'm wrong, because I don't want to go out there and just sell naked call options. Not on a stock that's at 35 today that was trading at 65 as on the open yesterday, and even higher in the after hours. Okay, it's a bear call spread because my expectations are that if GameStop is at or below 35 by the time you hear this podcast, I'm going to take all the money in between what I sold and what I purchased. Yes, I'm bringing in money on the 35 and I'm paying out money on the 40. It's a 5-point spread. I took $1 in. I took 1 point in. I'm risking 4. I'll get to that in a moment. Why am I trading weekly options? Because this thing moved from $17.50 on Monday to $65 a share on Wednesday. Could it go back just as fast? Yes, it could. I believe it's going to go back. Hey, it might go to 15 or 20 or 25 or 30 or 30. It might stay at 35. I don't care. My trade is set up where as long as we're at 35 or below, I take the full profit. I'm taking in one, I'm risking four. Why am I risking $4 for every one I take in? Because I'm doing the trade-off where I don't need GameStop to do anything. I just need it to stay at or below 35. And stocks statistically can do one of three things, right? They can go up, they can go down, or they can go sideways. And if it goes down or sideways, then I do well. Even if it goes up, as long as it's below 36, I'm going to make money because I'm taking $1 in. So my break even is 36. It's $1 above the strike I sold. My total risk is above 40. I can't lose any more than the difference between strikes. If it goes to 100, if I'm completely wrong, and all of a sudden the meme traders are maxing out their Visas and American Express and taking that money in and buying GameStop, and I'm wrong, well, I'm not going to lose more than 4 points per spread. Okay? So I sold the calls, the 35 calls, and I bought the 40 calls as multiple bear call spreads. Again, what's my risk, reward, and break even? My risk is the amount, the difference between strikes minus what I brought in. If I brought $1 in, my difference between strikes is 4. What is my reward? The $1 I brought in. I can't make any more than $1. What's my break even? I take the $1 that I brought in and I add it to the short strike. I shorted 35, so the $1 add that to 35. My break even is 36. Now, you might wonder how I determine how many of these trades to take. Well, that has a lot to do with your account size. That has a lot to do with something I call risk management. I'm going to give you the easy answer, and I'm going to give you the hard answer. The easy answer is I don't put on any more than would allow me to fall asleep any different than I normally do. I don't sleep that much to begin with, but the last thing I want to do is put on so many call spreads on a stock like GameStop where it's keeping me up at night. I had a certain family member, I won't name his name, said to me, hey, I can't go to sleep. I have too much of this position on. I've got too many of these XYZ trades on. This is a past trade that he took. And I can't fall asleep. What do I do? And I said, sell down to where you can't fall asleep. That's the simple answer. Okay? The more important answer would be really starting to understand yourself, understand your account, understand something called trade risk management. And that's after you've created a trading plan, what you've intended to accomplish, whether you're going to constantly be a directional or a non-directional trader or both, what markets you're going to trade, how it fits in your lifestyle. I mean, yeah, I know it's a mouthful, folks. Okay? It's a mouthful. So the thing that I want to mention is that trade risk management is what keeps you in the game, okay? Having a great trading strategy or have a great trading system or trading the right options or setting yourself up on the right options is great. But if you don't have trade management, if you don't have risk management on each trade, there's going to be a trade that's going to take you out. It happened to me in 1987, and I didn't have a strategy. I didn't have risk management. I had a guy on TV that was screaming his head off about something, and I went in with him. And you know what? He probably didn't have any dog in the game. He didn't have a dog in the hunt. I didn't know that at the time. I was 21 years old, taking not my first trade, my last trade of 1987. I didn't take another trade until 1988. I was out of money. I was one of those people that was maxed out on his credit card. One of those people that I was part of the 62% club in 1987. And in 1988, I decided I need to do something a little bit more than the paycheck. You know what? The best thing in the world happened to me was I lost all my money in 1987 because it happened when I was 21 years old, coming into 22. That's when it happened. I was 22 years old. It's better to learn that lesson at 22 than to learn it at 62 or 52 or 42 or 32. I mean, it was a good knock in the back of the head, and I needed it. It was a good time to have it. So I learned something about risk management then. And so, you look at the risk you're taking, and you look at the trade, and you ask it if it's worth the risk. And you look at things like, all right, well, what's my risk going to be? If it's a stock, are you going to have a stop loss in place? Is there going to be a stop? Is it an option? All right. And with options, now options are going to be, it's depending on if you're going to be a buyer or if you're going to be a seller of spreads. Options will have a finite, smaller risk. Even selling put options has a better risk than buying the stock because at least you're getting a premium. But where I'm going is this. What is your risk? And, the other thing I want to mention is a lot of novice traders, they do this. They lose money on a stock, then they come back and they hear that options are the way to trade. And yet they don't learn the first rule, which is getting trade risk management under your belt with a stock because, if you don't treat the option, and this is the thing, you have to treat the option at the same rate as the stock, 1 to 100. Okay, I go cash secured on a lot of my option strategies. What I basically mean is this: if I'm putting 50 grand into a stock, and I decide, options are going to be cheaper, I'm not going to take that 50,000 and put it into an option trade in place of a stock. That's just stupid leverage. That's stupid leverage. I am going to put in something of the options that will replace the $50,000 in stock. Okay? So there's things you got to do that. So it's not just doing your homework on systems, but it's about understanding how much, or in this case, how little you're going to risk in the options market on a trade by trade basis. And you could look at different types of trades that might help alleviate your loss, like limit orders give you, opportunity. Stop orders get you out. Maybe stop limit orders. There's pluses and minuses with that. There's also contingent orders or conditional orders. There's also OTO orders, OCO orders. One triggers two, et cetera, et cetera, et cetera. I mean, trailing stops, percentage stops. Those are all great. But the thing you need to think about when you put your trade on is how much could I lose? And are you comfortable with that? That's the important thing you need to know. And that will help you determine the number of contracts that you want to buy. Okay? So ask yourself these questions as you hopefully move into a career of success. All right? Do you understand the relationship between a stock and an option, and that the option is a replacement for stock risk and not a leverage factor for stock cost? Okay? Number two, does your broker offer you the ability to put your trade risk in place? And finally, can you diligently follow your rules? These are the questions I want you to ask yourself as we go through this process together. And as I end out this podcast, I'm looking at GameStop. We're trading around 34. So it's about where I put the trade on. It was up a little bit. It was going against me when I first started the podcast. Now it's kind of coming back down. We'll see where this ends out. You're going to be looking at this on Friday. Here's the thing that we can all grade Tom on. Where's GameStop close on Friday? If it's above 40, maximum loss. If it's below 35, maximum profit. If it's in between, then I got to do something before Friday's close because I have a spread on. And if it trades in between the spread, if it gets to expiration in between the spread, the last thing I want to do is end up holding stock at the end of the day on Friday. So if it's in between 35 and 40, I might be buying market on close stock because if it goes in between 35 and 40, you know what's going to happen. The 40s are going to expire worthless. The 35s are going to get assigned. And short call becomes short stock. So if I buy to close, then I'll buy to close the number of shares based on the number of contracts times 100, and I'll just close that trade up myself. But I am hoping for this experiment that we're either above 40 or below 35. So you can see how it turned out. All right. There you go, folks. Have a great rest of your day and a great weekend. And I'll be back again on Monday, and we'll just talk post-mortem and see how this trade worked out. All right. Bye, everyone.